According to some, the biggest bullish catalyst for crypto isn't a new technology or a protocol upgrade. It's the unlocking of the $12.5 trillion American 401k retirement market. This supposed avalanche of institutional capital will send prices to the moon and validate digital assets forever. Or so we're told. But when you see how these retirement accounts actually function, a different reality begins to emerge. This seemingly bullish regulatory greenlight is actually a mechanism designed to ensnare retirement funds in fee-heavy custodial Wall Street products. It is a highly coordinated legal mechanism engineered to permanently separate the average investor from their private keys. My name is Lewis, and you're watching The Coin Bureau. Back on the 7th of August 2025, President Trump signed Executive Order 14330, officially directing federal agencies to remove barriers to alternative investments in defined contribution plans. Then, on March 17, 2026, the SEC and CFTC issued joint guidance classifying Bitcoin and 15 other major crypto assets as digital commodities. And the final trigger was pulled on March 24, 2026, when the White House Office of Information and Regulatory Affairs officially cleared a new rule proposed by the Department of Labor. This rule completely rescinds previous warnings and provides plan fiduciaries with the legal cover that they need to offer digital assets to everyday workers. SEC Chair Paul Atkins has been the primary architect of this shift, explicitly pushing to open the gates for crypto to enter the massive 401k market under what he calls professional management. Crypto Twitter immediately erupted with euphoric price predictions, assuming trillions of dollars would flow directly into Bitcoin and trigger a permanent supply shock. And the math behind the euphoria is kinda compelling. The total United States 401k market holds approximately $12.5 trillion in assets. If these retirement plans allocate just 1% of their capital to Bitcoin, well, that represents roughly $139 billion in brand new automated buying pressure. To put that number into perspective, $139 billion is more than 3 times the cumulative net inflows of every single spot Bitcoin ETF launched in 2024 combined. So, a capital injection of that magnitude would fundamentally rewrite the asset's market cap. And major asset managers like BlackRock and Fidelity are already building the exact defined contribution infrastructure required to capture this incoming tidal wave of working class wealth. On the surface, this looks like the ultimate, final victory for mainstream cryptocurrency adoption. But behind closed doors, these institutions aren't building this infrastructure to grant you financial sovereignty. Rather, they're building it to monopolize the supply of Bitcoin and extract perpetual rent from your retirement savings. And speaking of staying ahead of these massive institutional power plays before they hit the mainstream headlines, this is exactly why you need the Coin Bureau Telegram channel. This is where we share the latest breaking news, provide deep dive alpha, and give you the most important updates, all pinged directly to your device so that you don't miss a thing. So sign up today by using the link down below or by scanning the QR code on the screen. Now, 401k plans do not operate in a free market. They operate under the strict, unforgiving regulations of the Employee Retirement Income Security Act of 1974, universally known as ERISA. Under ERISA Section 403, all 401k plan assets must be held in a legally distinct trust by one or more highly regulated trustees. Furthermore, it's mandated that these assets must be held by a qualified institution, which typically means a state-chartered trust company or a federally regulated bank. This legal framework creates an absolute, insurmountable barrier to self-custody. You cannot hold the private keys to the Bitcoin inside your employer-sponsored 401k. You cannot transfer that Bitcoin to a hardware wallet, and you cannot verify its existence on the blockchain yourself. Because of the ERISA fidelity bond requirement, allowing an individual participant to hold their private keys is structurally and legally impossible for the plan sponsor. So, when you allocate your 401k contributions to crypto, you're not actually buying Bitcoin. You're buying a beneficial interest in a trust, which is essentially just a paper claim to Bitcoin that is entirely controlled by a centralized financial institution. By funneling the working class's wealth into these specific ERISA-compliant vehicles, Wall Street permanently separates the retail investor from the underlying digital asset. And although the core ethos of the entire cryptocurrency movement is not your keys, not your coins, inside the $12.5 trillion 401k market, that ethos is legally dead upon arrival. The loss of your private keys is just the first layer of this institutional capture, though, because the true purpose of this infrastructure is relentless fee extraction. TradFi giants don't build multi-trillion-dollar infrastructure out of the goodness of their hearts. They build it to extract compounding rent from a captive audience. If you look closely at the actual data surrounding these new retirement products, you'll find a 5-layer fee structure hidden deep in the fine print. Layer 1 is the investment product fee itself, like the 0.25% expense ratio charged by BlackRock's IBIT, or the massive 1.5% fee currently charged by the Grayscale Bitcoin Trust. Layer 2 consists of administrative and record-keeping fees charged by the plan provider, which typically siphon off another 0.25% to 0.5% of your total assets every single year. Layer 3 is revenue sharing, a completely invisible mechanism where fund companies kick back 0.1% to 0.35% of your money to record keepers, just for shelf space. Layer 4 involves sub-transfer agent fees for transaction processing, and Layer 5 encompasses the massive bid-ask spreads executed during portfolio rebalancing. For context, Fidelity's own crypto IRA product charges a 1% spread on the execution price of every single trade on top of its standard management fees. When you stack these layers together, a typical 401k crypto product will realistically cost the retail investor between 1% and 2.25% annually. Now, that might sound like a small percentage, but let me translate exactly what that means for your actual wealth over a standard 30-year retirement horizon. If you invest $10,000 into a crypto product that generates a hypothetical 10% annual return, a zero-fee self-custody setup would grow to approximately $174,494. But if that exact same asset is trapped inside a high-cost 401k product charging a 2% total fee, your final balance drops to just $100,627. You lose nearly $74,000 to Wall Street middlemen, i.e., more than 7 times your original investment amount completely vaporized by compounding fees. Wall Street is taking a decentralized, peer-to-peer network that was designed to operate with fraction of a cent transaction costs and turning it into a centralized fee-generating toll booth. And you're forced to pay this toll every single year, rain or shine, whether the price of Bitcoin is hitting new all-time highs or suffering a catastrophic drawdown. But the absolute most dangerous aspect of the 401k trap isn't the fee extraction. It is the deliberate destruction of your financial liquidity during times of severe macroeconomic stress. The defining characteristic of a 401k is that your capital is locked inside a heavily restricted vault until you reach the age of 59 and a half. If you attempt to withdraw your funds before that age, the Internal Revenue Service hits you with a brutal 10% early withdrawal penalty. But that 10% penalty, that's just the beginning, because the entire distributed amount is also immediately subject to ordinary state and federal income taxes. For an investor in a standard tax bracket, this creates a combined effective penalty of 30 to 50% just to access your own money. If you need to pull $50,000 out of your retirement account to survive an economic emergency, the government and the tax authorities will instantly confiscate $18,500 of it. Now, apply this draconian liquidity trap to the historic volatility of the cryptocurrency market. Bitcoin is currently trading roughly 46.6% below its October 2025 all-time highs of $126,296. If you're holding Bitcoin inside a 401k during a 50% market crash and you lose your job, you could face an absolutely brutal decision tree. You can either watch your digital wealth evaporate while remaining trapped inside the plan, or you can withdraw the funds and instantly lose another 30 to 50% to taxes and penalties. You cannot quickly pivot to stablecoins without triggering plan restrictions, and you absolutely cannot withdraw the Bitcoin to a self-custody hardware wallet to protect it. This completely destroys the fundamental purpose of cryptocurrency as a sovereign, permissionless escape hatch from the legacy banking system. Caitlin Long, the CEO of Custodial Bank, has explicitly warned about the massive settlement mismatch between traditional finance and the Bitcoin network. Traditional banking operates on delayed T+2 settlement during standard business hours, while Bitcoin settles in real time, 24 hours a day, 7 days a week. During a catastrophic macroeconomic event, institutional custodians facing massive margin calls may be forced into automated, real-time liquidation cascades. If your Bitcoin is held by one of these custodians, you could find yourself entirely trapped inside the legacy banking system's walled garden while the institutions sell off the underlying assets to save themselves. Cast your mind back to the 2013 Cyprus banking crisis, when the government unilaterally seized private deposits to recapitalize their failing financial institutions in a massive bail-in. Bitcoin was engineered specifically to prevent that exact scenario by allowing everyday citizens to hold unconfiscatable wealth outside the reach of desperate governments. But if your Bitcoin is locked inside a 401k at a state-chartered trust company that is entirely subject to government regulation and institutional insolvency procedures, well, you have recreated the exact problem Bitcoin was invented to solve. And while retail investors are locked in this regulatory prison, the massive institutional custodians are centralizing the entire underlying supply of the Bitcoin network in the background. As of late March 2026, BlackRock's IBIT ETF alone commands $51.7 billion in assets under management, holding approximately 800,000 Bitcoin. Strategy holds another 761,068 Bitcoin. And Coinbase custody currently secures roughly 90% of all of the assets across the entire $82.6 billion spot ETF market. As $12.5 trillion in 401k capital is systematically pointed towards these specific institutional products, millions of Bitcoins are being permanently removed from circulation and locked in corporate cold storage. Nick Carter of Castle Island Ventures has clearly articulated the existential threat this poses to the network's governance structure. As these massive custodians accumulate an ever-growing percentage of the total supply on behalf of passive 401k investors, they could easily transition into activist investors. With fiduciary obligations to protect trillions of dollars in client assets, these institutions could exert overwhelming economic pressure on Bitcoin core developers to alter the protocol's base layer to suit Wall Street's compliance needs. We have seen this exact financialization playbook executed before, and we know exactly how it ends. In November 2004, the launch of the GLD ETF revolutionized the precious metals market by allowing retail investors to buy gold directly in their standard brokerage accounts. This was celebrated in many quarters as a massive victory for access, and the price of gold subsequently skyrocketed from $400 an ounce to roughly $1,900 an ounce by 2011. But despite this incredible price appreciation, the retail investors who bought the ETF learned a very harsh lesson about institutional custody. They did not own gold, they owned a paper claim to it, and only massive authorized participants were ever allowed to redeem those shares for the actual physical metal. The retail public was permanently excluded from physical redemption, creating a massive paper market that fundamentally altered how gold traded during liquidity crises. The integration of crypto into the $12.5 trillion 401k market is following the exact same historical trajectory. It will undoubtedly drive prices higher in the short term as billions of dollars of automated retirement contributions blindly purchase institutional Bitcoin products every 2 weeks. But we must ask ourselves what we are sacrificing for those short-term fiat gains. By cheering for Wall Street to package our digital sovereignty into heavily regulated, fee-extracting retirement accounts, we are willfully walking into a compliance dragnet. We are allowing the legacy financial system to capture the supply, extract the yield, and permanently separate the working class from the private keys that guarantee true financial freedom. We didn't leave the financial prison. We just repainted the walls and called it a diversified retirement portfolio. But what do you think? Is opening the 401k market a massive win for your portfolio? Or is it the final nail in the coffin for true decentralization? Let me know your thoughts in the comments. And if you want to dive deeper into how institutions are changing the underlying mechanics of the crypto market, well, you can check out our video on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.